It always starts the same way, with a mood, not a moment. The indexes climb, the headlines glow, confidence becomes louder than caution. People stop asking, what can this do? Begin asking, how quickly can I profit from it? History listens to that tone. History remembers. The Roaring Twenties were a lesson in collective imagination. Radios filled rooms. Cars filled streets. Factories ran day and night. Ordinary citizens walked into brokerage offices the way earlier generations walked into markets. Hopeful, eager, convinced. The stock market stopped being an institution and became a ritual. By today, believe forever. And belief is the fragile element of any financial system. October 1929 did not land like thunder. It arrived as a sequence. Small cracks, then larger ones, each ignored until the whole facade fell. On Black Thursday, a whisper of selling became a roar. On Black Monday and Black Tuesday, paper value evaporated as if someone had reached into the trading pit and removed the air. Banks tightened, jobs vanished, confidence dissolved. The economy, built on credit leverage, and a public convinced of endless growth, collapsed into the Great Depression. Those months and years taught the world something raw and simple. When a market is driven more by belief than by underlying production, it is subject to a violent reversal. Psychology matters as much as balance sheets. Trust is a currency. When trust fails, so does everything that depends on it. Now, in 2025, the rhythm sounds familiar. The tools have changed: smartphones, cloud servers, machine learning models, but the psychology has not. For more than a decade, central banks and governments have used ultra-low interests and expansive balance sheets to stabilize crises. Those policies achieved something. They prevented immediate collapses and produced a long tail of speculative behavior. Easy money became a habit. Leverage became normal. Risk was rewarded with little immediate penalty. People began to treat prices like destiny, not signals. Tech valuations soared on future promise rather than present profits. Retail investors, empowered by apps, entered markets with small capital and enormous conviction. Social platforms turned speculation into spectacle. Crypto promised a parallel financial world, while derivatives and structured products hid layers of leverage that few fully understood. In short, the scaffolding changed, but not the incentives. Listen to the numbers. Global debt is historically large. Corporate leverage has increased. Real estate prices in many markets are elevated relative to incomes. Margin positions and off-balance sheet exposures are substantial. Central banks face a dilemma: raise rates to fight inflation and risk breaking fragile institutional borrowers. Keep rates low and encourage further speculation. Either path contains danger. A market crash is rarely the work of a single cause. It is the failure of many interlocking assumptions. In 1929, margin loans magnified losses. Banks that had lent too freely found themselves insolvent. The real economy, factories, farms, wages felt the shock. Today, financial plumbing is global and instantaneous. An algorithm can pull liquidity from multiple markets in seconds. A single policy surprise, a sudden rate hike, a liquidity shock, a high-profile corporate failure can trigger automated sell programs, which cascade into liquidity shortages, which force institutions to mark down assets, which further undermines confidence. Speed amplifies fragility. Another parallel: complacency about regulation. After 1929, reforms followed. New rules, new safety nets, new institutions aimed to reduce systemic vulnerability. The world improved, yet each crisis teaches a version of the same lesson. And each subsequent generation finds ways to work around old constraints. Shadow banking grew. Complex products multiplied. Global capital found channels beyond the reach of the safeguards designed after earlier disasters. Regulation adapts slowly. Markets adapt quickly. Human behavior is the constant. In 1929, ordinary people believed the market represented permanent wealth. In 2025, many believe technology and monetary policy have permanently changed the rules. Both claims have the same structure: an assumption that the past no longer constrains the present. Yet economic systems are still bound by scarcity, productivity, and trust. When the belief that transcends those bounds is challenged, the correction can be swift and bitter. What might a modern crash look like? It would likely begin in a crowded sector, one where expectations are compressed, valuations are thinly supported, and leverage is high. A high-profile collapse, a major tech firm missing earnings, a large leveraged real estate firm defaulting, or a sudden correction in digital assets could be the flashpoint. Once the flashpoint hits, liquidity providers withdraw, prices gap lower, and automated systems accelerate selling. Market makers widen spreads. Margin calls force cover. Correlated assets fall even if their fundamentals differ. Confidence falters, not because fundamentals change everywhere at once, but because the public learns to distrust the myth of perpetual upside. The consequences would not be the same as in the 1930s. We live in a more diversified and networked economy. Policy tools are more sophisticated. Social safety nets are broader. But while the form of pain differs, frozen accounts, illiquid shadow entities, currency instability, the human cost endures, jobs lost, retirement plans damaged, small businesses squeezed, political pressures intensified, financial turmoil fuels social fragmentation. There is an additional danger in the 21st century: policy exhaustion. Governments have used the extraordinary measures available after crises repeatedly. Each intervention buys time and also creates moral hazard, the expectation that authorities will act again. If markets come to price that expectation, risk increases. The larger shock arrives when policy firepower is limited. The range of possible outcomes is worse. So what does history advise? First, humility. No system is immune. Second, respect for balance between growth and discipline, between credit expansion and real economic output. Third, the importance of clarity in communication. Markets respond to signals as much as to data. When official institutions misread inflation, employment, or system stress, their actions can inadvertently worsen the cycle. For creators, investors, and citizens watching now, there is a practical test: separate conviction from convenience. Ask not only where prices may go, but why they should belong there. Scrutinize leverage. Test assumptions about liquidity. Consider scenarios that stress counterparty relationships. Build margins of safety into portfolios and plans. It's not because prophecy demands it, but because history rewards prudence. This is not a cry to retreat from markets or from technology. Crises clear illusions and create opportunity. After the Great Depression, painful as it was, new institutions and norms emerged that made modern finance more resilient. Innovators adapted, economies restructured. The eventual recovery involved new industries, new regulations, and a different social contract. If 2025 proves to be the year when the patterns of 1929 reassert themselves, the world will suffer, but it will also learn. The crash will separate true value from narrative value. It will force institutions and individuals to reckon with assumptions about perpetual liquidity and limitless leverage. It will require rebuilding trust, not by slogans or emergency printing, but through actions that restore the link between money and real economic production. The final truth is both simple and harsh. Markets reflect what we believe, and beliefs can change on a dime. The comfort of certainty is a dangerous sedative. The clear-headed take from the past is to plan for uncertainty, to respect limits, and to build systems, financial and social, that can absorb shocks without turning them into calamities. History never repeats exactly. It rhymes. The rhyme now sounds unmistakably like the 1920s. The forms have modernized, the instruments are digital, and the speed is unprecedented. But the psychological pattern is familiar: easy money, rising leverage, collective belief, surprise, and then correction. If we are to avoid the worst outcomes, we must translate that recognition into discipline, transparency, and a willingness to endure short pain to prevent deeper harm. When future historians write about this decade, they will ask a simple question: did we learn, or did we repeat? The answer will rest not on predictions, but on choices. The choices policymakers make, the risk management investors practice, and the readiness of societies to build resilience before the next collapse. Those choices determine whether 2025 is remembered as a near miss, a crisis, or the opening chapter of a deeper correction. For now, the signal is clear. The echoes of 1929 are audible. The same vulnerabilities exist, dressed differently. That is not an invitation to fear. It's an invitation to prepare, to think, and to act with both courage and caution. Because in finance, as in history, luck favors the prudent, and survival depends on the ability to see patterns, accept reality, and adapt faster than the next cycle. We are not outside history. We are inside it, writing the next stanza. Listen closely. The melody is familiar. The tempo has changed. The choice is ours.